liquidity. So historically, Bitcoin has been one of the purest liquidity plays. So when you look at various measures of domestic or global liquidity, generally when liquidity is rising, that's pretty good for Bitcoin, and when liquidity is falling, that's usually Bitcoin's usually either going down or sideways. And starting around the beginning of Q4 of last year, some of the liquidity indicators started to bottom and turn back up, at least temporarily. And I think that, much like other assets had a rally, I think Bitcoin would have had a rally back then.
Hi, I'm Crypto Positive. If you like this video, please leave a comment and subscribe to the channel. It's very important to the channel and gives me motivation to make more videos about crypto for you. And now let's go to the video.
If not for the whole FTX debacle. And so that kind of delayed the rally, but with that somewhat resolved, and now kind of moving forward, I think Bitcoin and other aspects of the ecosystem are kind of having their rally, which is really a liquidity rally. And so basically liquidity indicators look okay for the next couple of months, but overall long term, they're still not in a very good place.
Well, it's really interesting because before the price started to go back up, you wrote in your last newsletter that the last time the 2-year Treasury yield dropped below the Fed funds rate near the top of interest rate hiking cycle, it marked the end of the cyclical bottom for Bitcoin. So is that perhaps what we're seeing?
Yeah, so I kind of pointed that out as like something that no one should trade on that specific thing, but it's more like an observation. And that part of the underlying causation with that, correlation is that generally that's the 2-year, the market kind of assessing that the Fed's getting close to being done its hiking cycle. And so that's kind of what happened last time, where when the 2-year rolled over the Fed funds, that ended up being the top of the hiking cycle, and that ended up marking the bottom of Bitcoin. And so right now, I think we're seeing shades of that. It doesn't mean that it's the exact bottom. It doesn't mean that the bottom's guaranteed in. But I do think that the part of the downward move in Bitcoin that was specifically from the dollar rally, I think that's kind of behind us. And now I think we probably have a longer grind ahead of us to, kind of start rebuilding from here. But I think when you look in the second half of this year, there's still some liquidity concerns. And so kind of like how in the prior Bitcoin bear market, you had the major bottom in, say, late 2018 into 2019. That was the big bottom. But then you kind of had like a later liquidity shock through March 2020, where you went down and went up much faster. It was again, another liquidity issue. I wouldn't be surprised something like that, like a sharp retest, but it's too early to say because it partially depends on what humans do, what Jerome Powell does, what different policymakers do. And of course, that's always impossible to predict.
So do you think right now that Bitcoin's more affected by the macro environment as opposed to, let's say, the crypto dominoes that were falling, even though we just had, I believe, right before we started this conversation, headlines that said DCG is preparing, or Genesis is preparing potentially for bankruptcy?
So I think there's still big things like that can move the crypto specific industry. But overall, like historically, Bitcoin has been very correlated to macro factors and specifically liquidity. And I've looked at it over the past couple of years because a lot of people, they look at the halving cycle. That's obviously got some degree of correlation. But then if you look at, say, Bitcoin and the Purchasing Managers Index, which is one of the leading macro indicators, generally when it's rising, it means the economy is expanding, growth is accelerating. When that's going down, growth is decelerating. If it goes below 50, it's potentially outright contracting. And generally, Bitcoin's rather correlated with PMIs. It usually runs a little bit ahead of PMIs. Like it usually front runs it a little bit. And then I looked at it and saw that basically liquidity generally front runs PMIs, and Bitcoin tends to be very correlated with that liquidity. And so for the past 3 cycles or so, it's already been somewhat of a macro asset in that sense.
Before we get back to the video, I want to tell you that you can get a free $100 bonus from iTrust Capital by clicking the link in the description right now. Now let's get back to the video.
But of course, if you have a big enough industry-specific blow-up, like we saw with FTX, and like you might see with some of these others, that can temporarily override the macro factors because it doesn't matter if liquidity is good if there's some massive forced selling whale out there.
How would you describe liquidity right now in the treasury markets? Let's turn a little bit more to the macro environment, because one thing that I guess I'm just constantly surprised by is the fact that we aren't officially in a recession yet. We had 2 consecutive quarters of negative GDP growth, but then we had positive. And I know that the service sector is still relatively strong. There's low unemployment, but it certainly feels like we're in the middle of this very significant economic slowdown. So how are we not in a recession?
So most of the indicators point that we are like early stage recession or late stage expansion. And so a lot of the leading indicators like, conference board leading indicators, purchasing managers indices, those things are rolling over. Industrial production's rolling over. Inflation adjusted retail sales are rolling over. And the strong area, as you point out, has been the labor market. Historically, that is a lagging or coincident indicator, meaning that by the time unemployment is rising, you're usually already in a recession. And that's part of the reason why those two negative quarters weren't kind of a full recession, is because unemployment was still pretty low and not really worsening yet. Even in the labor market, though, we're starting to see that some of the early indicators there are not looking good. So, for example, if you look at overtime hours, those are on the downtrend. If you look at temporary help, that generally is a more volatile and leading part of the overall labor force, because imagine if you're a small business and you're running into tight times, you might reduce your temporary help service before you would let go permanent employees. And so those are actually down year over year. And so basically there are multiple small signs that the labor market's cracking, which combined with all the other indicators, inverted yield curve, contracting PMI, it kind of points towards likely recession. But I think we're still in the kind of either the pre-recession stage, or they always declare a recession months after it happens. So it's possible that this is like already part of the recession. But if it is, we I think still really early stages.
And how are valuations looking? Because I know that there was a concern about equities earning multiples last year, but now it's more so corporate earnings for this year, right?
Yeah, so 2022 was a story of earnings multiple contraction. So it's not like earnings went down yet. Basically, you had some non-energy earnings fall a little bit. That was offset by energy earnings. So overall, S&P 500 earnings are currently fine. But you had because you had a sharp rise in interest rates, you had a sharp reduction in valuations. And one simple way to think about it is if usually the 10-year treasury is like the benchmark that you compare equities against, right? If you can get a 6% yield on a 10-year treasury, you might look at equities and say, I'm only going to invest if I can get 5% better than that, right? So I want 11% expected returns. Therefore, I need to buy them pretty cheap if I want to comfortably beat the treasury. On the other hand, if the treasury is yielding 1% and I still want a 5% equity premium, I might buy equities even though I only anticipate that they're going to give me a 6% return, and therefore I'm willing to pay more like a higher earnings multiple, lower dividend yields, things like that. And so as you've seen a sharp rise from your zero yields all the way up to well over 4% at one point, that put a lot of downward pressure on equity valuations, especially growth-oriented equities.
Пустой зал, ожидание вокзала. Стою и смотрю куда-то в сторону перрона.